Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt. I look at the week's financial news that can be a bit confusing, misleading, and take you, of course, help to make it actionable, understandable, and clear. What a week. Therefore, what a show. The temperatures in our beloved Dallas, Texas, on the up and up. So is the stock market. Bubbles and rumors of bubbles. So excellent lineup the directors have got for us, the producers have got for us. We're going to look at why it's so hard to spot a stock market bubble. And it also looks awfully like a stock market bubble. We're going to look at a Michael Burry. You remember him from The Big Short. He's got concerns, again, about a bubble. And then we get to delve into Whirlpool. Yes, the appliance maker. What lessons can we garner from their dividend suspension? We'll talk a little about dividends, and hopefully you learn something. But let's talk bubbles. Bubbles. Same day. This I got a chuckle out of this. Last Friday in the Wall Street Journal. I'm gonna read what happened. Very same day. Headline: Why it's so hard to spot a stock market bubble. Next headline: It's looking an awful lot like the tech bubble. One article by Jason Zwig, the other by Spencer Jacob. Of course, we're with Mr. Zwig. We'll talk a little about that. Zwig's article, subheadline: A sudden surge in share prices makes us all think we know what's coming next. Ooh, he's on to something. I'm going to read a little bit of this article. If the stock market's a bubble, that's dangerous. If you're positive it is or isn't a bubble, that could be even more dangerous. Yeah, listen to this. In April, semiconductor stocks rose more than 38%. So that's the highest monthly return since February of 2000. Google, they're up 10% on April 30th, one day. That added $421 billion to the market value in one day. Are you feeling bubblicious? So, Mr. Zwig gets a little feedback from his readers, and some people say, yes, we're in a bubble. No, we're not in a bubble. One of the jokes is he heard back from someone who said this: when I think the stock market is overpriced and then it doubles, that's the bubble. He was referencing 1998, 1999, the NASDAQ 100 gaining 102% after returning 85% in 98. So isn't that a funny one? Yeah, it's in a bubble when I think it's overpriced and then it doubles. Doesn't that kind of humble us a little bit, make us realize, yeah, this is tough. So they have one way to think about it. Share issuance. I thought this was actually interesting. So they interviewed someone. I said, you know what I look for when these companies start issuing lots of shares? Now let's break down what that means. IPOs, these initial public offerings, when they come to the market and they start selling shares, that's what happened in the late 90s. That's when you kind of know, or you think you know. You're in a bubble. This is gentleman, the last name Lamont, Owen Lamont. He's a portfolio manager at Acadian Asset Management in Boston. The Boston Red Sox. He's written extensively about market extremes. He says it's this stock issuance. So, 2020, 2021, when all those SPACs, black boxes, SPACs issued stock, when that bubble burst, people lost $100 billion. .com mania of the late 90s. eToys, Pets.com, a bunch of other internet companies. They put a ton of stock out to the market for them to buy. Well, this guy's saying, well, what about SpaceX, Anthropic, and OpenAI? Aren't they coming in with a bunch of share issuance? Well, you know what I think? I think I don't know. Believe it or else, that's a good place to be. And then I love this. Same day, Spencer Jacob, it's looking an awful like the tech bubble. So he walks through some of the stock performance of companies ending in March 2000 and how just amazing they did. And he's comparing that to other times in history. So the Roaring '20s in the United States, the railroad fever, Japanese property, tulip bulbs. Oh, are we scared yet, listener? Are we scared yet? So he's saying this recent AI boom, it's problematic. So listen to this. Through the third week of March of 2000, the top performing 10 stocks in the NASDAQ were up an average of 622%. Through this Tuesday, same kind of companies are up 784%. Now, I think this is kind of confusing, candidly, the time frame, but you see how people are making these analogies. Big moves in the late 90s, big moves today, bubble, bubble, bubble. Maybe they're right, maybe they're wrong. That's why I read Zwig's article first. It's a hard game, isn't it? It's a hard game. And then what you'll never see, and you'll see this when I read the Michael Burry headline, but what you won't see typically is accountability for the doomsdayers. So these doomsdayers and the bubble, the fear mongers about the bubble, they get to write these articles every week. And you know what? They'll eventually be right. At some point in the future, could be tomorrow, could be 10 years from now, they'll be able to look at themselves in the mirror and say, I told the listener, I wrote in the paper that they should be weary. They shouldn't just close their eyes and bury their head in the sand like an ostrich. They should be watchful of these price to earnings ratios, of the share issuance occurring. It's not really actionable, is it? Yeah, it's not. I've probably mentioned this on the podcast before. I read a book in my youth called Yes, You Can Time the Market. And I was relieved. I think this is one of these Barnes & Noble deals. If you're a Dallasite, you'll appreciate this on Northwest Highway. I would walk into Barnes & Noble, turn to the right, and I first started reading about these types of books in the late 90s. So, oh, wow, it was Internet Stocks Mania. And this book, and I believe it was Ben Stein. I know he was an actor as well, but Yes, You Can Time the Market. And there's this big chart in the book. I was so relieved by the way to learn I could time the market. What a relief. I've been sitting here, just sail to the wind. The market was going to take me anywhere. Now I know I can time it. So I read what they did. They overlaid this chart with the stock market, and they said, hey, all you have to do is look at these price to earnings ratios. That's the amount of money you spend per dollar of earnings in these companies. And as long as you stay in, buy when it dips below the band and you sell when it gets above a certain level, you would have avoided the 1929 Great Depression. You would have avoided some of these scary things in the late 90s. You would have avoided the Nifty 50 in the 60s or something. Anyway, wasn't alive, but I could read about it. Why I didn't adopt this policy is, as I read, I realized this would necessitate, in some periods, staying out of the market for 20 years, 15 to 20 years. That's insane. No, you cannot time the market. I should have written a book right then. No, you cannot time the market, and just taking direct aim at this book. But for a moment there, about chapter 3, I was thinking, this is great. I can't wait to tell everybody, yes, you can time the market. No, you can't. No, you can't. Historic data may not be extrapolated to the future. You may not be able to look at the past and look at the numbers and the price to earnings ratio and put it forward for today. And oh, by the way, if we could soberly look at ourselves in the mirror, you know what we'd probably say? Write down all your predictions. And we don't. No one keeps track of this. But if you did, think to yourself, you know what? Did I think the stock market was in a bubble last year? Think about it. Did you think the United States stock market was in a bubble last year? Kind of felt that way to me. Well, in the last year, you're up 27%. So was that a bubble last year? Was that actionable? I bet you feel crazy. What about 2 years ago? It kind of felt bubblicious, didn't it? The U.S. stock market's up 41.6% in the last 2 years. So, guys, how are we going to do it? And if you're Mr. International Stock Market, last year in the internationals, you're up 29.5% last year. But I thought it was last 2 years, you're up 38.7 international stocks. But what about all these problems? What about Russia, Ukraine? It's so hard. Don't take the bait. And in fact, I say smart. What I mean is that the most interested in markets struggle the most with this. So I'm interested in the stock market. I like this stuff. It's hard for me. I have to set rules for myself because every pastor needs his own sermon. Well, every podcaster needs his own truth as well. So yours truly, I always think the market's overpriced. Always. I've basically never thought it wasn't overpriced. And to let you know how bad I am, I think it was 2013. In 2013, I thought the market was a little toppy. It's up about, 400% or so from that point in time. But I don't know if you remember this. We're coming out of 2009, 2010. It had a little bit of a double dip in 2012. And, here we go, the dead cat bounce. I remember people telling me, Robert, this is a dead cat bounce here. This market can't handle. Well, we're up 400%. And I didn't want to invest. I overrode my instincts. Believe it or else, one of the finest estate attorneys and tax attorneys in town, Nelson Hunt, I remember, I would go back to this 2013 moment. He's great. He doesn't give a rip about markets. He just follows rules. You're supposed to buy, you buy. Thanks to him, I stuck with it. But I had all these facts and figures and historic price to earnings ratios and what the market was. I had thought through it for hours. No, you just click the button, done. The wisdom of older brothers. So, hey, what's the lesson? Maybe you need a team. Maybe you need an hourly financial advisor. Maybe you need someone else who can just help us out from ourselves, listener. We've met the enemy. We've looked at him in the mirror. It's us. And Whirlpool. Now, this headline, for 70 years, Whirlpool paid a dividend. Suddenly, they can't afford one. Now, I'll give you a little background on Whirlpool. Many of you may know Whirlpool. They make appliances. They make a lot of appliances. They may make appliances that you use in your house. Now, wait a second. How could a company that makes appliances that I use, therefore I'm buying them, how could they be in these dire straits? So century-old Whirlpool has paid a dividend through 10 U.S. recessions, the article explains, and every global crisis since the 1950s. But the American manufacturer's cash crunch has gotten so severe that it's suspending the payment until further notice. What? This is the Maytag, KitchenAid, Genair. I got myself a Genair burner. My KitchenAid stuff basically died out. I got a microwave, a Whirlpool microwave. So I use the products. I'm doing just what Peter Lynch over at Fidelity told me. Investing in you'd be investing what you know. And then these dividend champions, you ever heard of this? Oh, these are perennial dividend payers. You can buy these and just trust. Well, Whirlpool's blaming the Iran war for driving U.S. consumer confidence to 50-year lows, as oil prices added ongoing concerns. Whirlpool's origin stretches back to 1911. So what lesson are we learning? Now, this is one of my usual punchlines, but individual security selection is very difficult. Historic performance does not mean you will do well in the future. And brands that this is where I don't like taking a different opinion than Mr. Peter Lynch, very successful man. And there's a sense where I probably agree with him. It's better investing in what you know than not. It's a wonderful screener, but it can betray you. You may use a product from a company, and that company could be in big, big trouble. And then don't fall in love with dividends. I see this all the time. Oh, this company's got a great dividend. It's got a great dividend. Paid it for 50 years. Doesn't matter. For 70 years, Whirlpool paid one, and it's gone. AT&T cut theirs a couple years back. So dividends can really draw us in. It's like a light outside and a bug. I've just noticed, I've seen investors just become so obsessed with dividends. I was, by the way, there's a group called Wisdom Tree, and I thought, oh, gee whiz, this is wonderful. I'm going to only invest in dividend stocks. That'll protect me. Well, it turned out that it wasn't helpful at all. Market cap indexing is the answer, listener. Market cap and the good old fuddy-duddy. It's that, give me that old-time religion. Give me that old-time religion. It's good enough for me. Just give me that old-time investing. It's good enough for you. It's good enough for me. We don't have to get complicated. We're not going to sound smart at the cocktail party, but you can handle it. You can handle it. We can do it. Persevere. And I didn't mention this at the fore, but I talked to little Michael Burry. I wanted to end with a little Vanguard news. This is a little surprise. I didn't tease it, but a little Vanguard news. Just to be watchful. Just to be watchful. Here's the deal. Vanguard, big fan. Big fan. However, not a static institution. The Wall Street Journal had an article saying that they're bringing in one of these expert bond pickers. So there's a new Vanguard hire. This is an article by Jack Pitcher. A new Vanguard hire highlights bond picking push. Low-cost investment manager NABS, portfolio manager from Morgan Stanley, while it builds out active funds to challenge incumbents like PIMCO. Now, I'll speak positively. What's my positive is their active funds are much cheaper, much, much cheaper. They're only charging, this is almost index fund like 0.1% annual fee. So great. All right. Who am I? Who am I to complain? Well, I can complain. I know how to complain. The index bond funds are so much better. Wouldn't you know it? The SPIVA report the Spiva report, that great referee that keeps score whether active, which are the stock pickers, and passive, who's winning, it's just as demonstrative that bond indexes are better. So our friends at Vanguard, they're doing what you would expect a company to do. They're building out their product set. They've got a new CEO. But they're losing something too. What are they losing? That trusted status. It's this idea that you roll in to a place and you just don't have to think. There are very few institutions like that where you roll in, you don't have to worry about getting cross-sold, you don't have to worry about having products pushed on you that aren't helpful. It is just the Hippocratic Oath, do no harm. It's more of a supermarket, and that's okay. You've got yours truly on the podcast to teach you how to shop, but it is a supermarket with products that aren't always helpful to you and to me. So we gotta be sharp. Vanguard's bringing in these hotshot stock pickers, but we know, you know and I know, stock picking, bond picking, not going to end well. The proof is in the pudding. The data is overwhelming. Evidence that demands a verdict. It doesn't work. It doesn't work. What does work? Have you ever thought about, listener? Have you ever wondered, how should I invest, Robert? You just never told us. You've never mentioned it. I'll tell you how to invest. Keep those costs low. Keep that investing simple. And keep that time horizon long, because that is what's going to give you the best shot on your investing journey. Until next week.